This is the last video as it relates to the different modules of the sport finance class. This is module 6 and 7 combined, and this is one of probably the most interesting components of this class, because you're going to be starting to apply what you've learned elsewhere in terms of trying to develop strategy. So when we start looking at this, our first approach is we're going to be taking a look at financial forecasting and planning, and that's going to be taking a look at where do we want to go? Well, what do these numbers tell us? Similar to like the budget, how it sets a roadmap, you have to develop a roadmap for the entire organization, and looking at the entire organization as a broader entity and trying to figure out where you want to go, what do you want to do with that organization. So financial forecasting is trying to take a look at where do we want to go in the future? How can we increase sales? How can we reduce expenses? This is where the senior executives get their payday, and where they really earn it is not just trying to say, here's what the numbers are. The numbers are what happened. Well, we're trying to look at why those things happen, and then look towards the future and how can we do better in the future. That's what we're trying to take a look at. So when we start taking a look at financial forecasting, this affects all sorts of different areas, such as short-term cash flow, long-term cash flow, what we might need, like when do we need to go to the bank? When do we need to borrow? Do we have a line of credit with the bank that we can address? When do we need to do that? When do sales come in? If a majority of our sales come in at one part of the year versus another. For example, if you're a team, it might be in the 2 months before the season starts that you'll get 80% of your revenue coming in if you're relying upon attendance as your primary source of income. If you are a broadcast type league where you have a nice broadcast contract, do you get that payment every month? Is that twice a year, 3 times? That will help develop approaches to what your strategy might be, because you might need cash at certain points, and at other points you might be flush with cash because you just received a major payment. Some of the things that we're going to be taking a look at with this financial planning will be like the supply and demand analysis. We might have to take a look at that in the context of, for example, if you're a manufacturer and you need to bring in rubber, and the cost of rubber fluctuates because it's a commodity. Well, how much are you paying at one point versus another point? And then develop a strategy for that. What if you have to buy from a foreign country? What if their currency changes? How will that impact you? If their currency gets strong and the dollar is weaker against it, as an example, you're going to have to be paying more. That's going to impact your total cost. Well, the next thing we start taking a look at in this module is managerial accounting, and looking at different ways within which to analyze an organization. Now, financial accounting is one thing. Managerial accounting often takes a look at some of the intangibles within an organization and to see how well it is doing. Some examples of approaches that might be used include triple bottom line, where an entity will examine itself in terms of a more holistic manner and try and take a look at what is its impact on the people and on the resources out there. So it's not just the income, how much money you make, what's your impact on an organization or on a community or on the environment, as an example. We also might use what's called the balanced scorecard approach, which is a way to look at not just what external people take a look at, but internally what we want to take a look at, and are we in fact doing a good job with what we're doing. For example, with employee training and development, are we doing a good job at that? The balanced scorecard will take a look and say, let's not just look at the financials, let's look at a broader area. But a lot of what we're going to be doing is financial controls, and that's different numbers. What are they and what do they mean? Now, part of this will focus in on what we call benchmarking. We're going to be taking a look at how do we compare to others. So throughout these 2 modules, we're going to be examining one company as it relates to others within that industry segment. So if you're a publicly traded company, let's say an auto racing company, and you own racetracks like International Motorsports, well, if that's the case, you can compare yourself to other entities. If you're trying to compare yourself to casinos, they're maybe in the entertainment sector, but that's a very significant push to try to compare yourself to that. So you want to make sure that you're comparing yourself appropriately, like a Nike's to an Adidas. But you have to make sure, are they all publicly traded companies? If you're trying to compare yourself to a privately traded company, it's not the same thing. It's like comparing apples and oranges. Yeah, they're fruits, but they're not the same kind of fruit kind of thing. And so what we often do is we'll be taking numbers from the statement of cash flow, the income statement, and the balance sheet, and using those to develop equations that make it easier for us to analyze somebody. Because we're taking a look at, let's say, Nike versus Adidas. Nike might be 4, 5, 6 times the size of Adidas. So if you're trying to compare just the income of one versus another, they're going to be completely different. But if you could look at it as a percentage basis, that's going to help you decide, are they doing pretty well or fairly well in comparison one to the other, or is one doing much worse than the other? That will be seen there. So what are some of the examples that we have with the different ratios that we're going to be looking at? Because what you're basically looking at is ratios. Well, we're going to be taking a look at a number of different ratios and how they impact an organization. Now, when we start taking a look at ratios, you might look at cost, volume, and profit analysis, contribution margins, how they contribute to the overall organization, comparative analysis, looking at one company versus another, and you might do what we call horizontal analysis, where you look across ways, where you look at various years, or it could be vertical analysis, where you look at different components within a company as a percentage of a base amount. So it might be that we spend 10% on marketing as an example, and then you could take a look at, well, are we in fact hitting that? And that's going to be one of our ways to approach this kind of ratio analysis. Now, there are a couple different approaches that we use when we start taking a look at the numbers. The primary focus that we're going to be taking a look at are going to be liquidity ratios, activity ratios, debt ratios, and profitability ratios. Now, when we start taking a look at this, the liquidity ratios, can we pay our debts? Are we liquid? And so we have a number of different ratios that are used, such as like the current ratio or acid test ratio, quick ratio, and these are all designed to help us take a look at a company and can we pay our bills right now. And that is critical to know, because you have to know if you're facing some financial hardships, well, then you might not be able to pay your bills, and that might be a sign to creditors or to people that own stock in the company that the company is in financial hardship. Activity ratios, it looks at how are we using our resources. Excuse me. So when we look at our resources, we're looking at our assets primarily. Are we using our assets well? Are we incurring liability in an effective manner to help grow our income? And so you're going to be looking at like average payback period, average collection period, inventory analysis, labor cost, and things like this. All these different things to take a look at, your assets, and are you using them effectively? Then the debt ratios, there's a number like total debt ratio, debt to equity ratio, debt to asset ratios, things like this, which take a look at how much liability you've incurred and are you able to use that effectively to grow the organization. And so that's an important frame of reference to have. Then the profitability ratios that are going to be discussed are going to be taking a look at the broader perspective of, are we in fact making a decent amount of profit, and then are we in fact giving some of that back to shareholders in terms of equity and increasing equity, or are we investing it into the company to grow revenue in the future, things like that. Those are the four primary areas, but within those, each one of those areas is detailed much more succinctly. There's a lot of websites that I encourage you to go to that are highlighted in the modules that will give you greater detail about each one of those ratios. Now, when we start taking a look at all these ratios and the benchmarking, why do we do this? It is for one basic purpose: strategy. What do we want to do in the future? How are we in fact going to be doing that? So it's incumbent upon you to be very open-minded as we start taking a look at these numbers, because you've seen companies, or we have examples of companies that were on the verge of bankruptcy and have a major turnaround. And then we've seen companies that are phenomenal, and because of one mess up, they could be destroyed and demolished. Some of the companies that were industry giants 50 years ago are no longer in existence because they didn't take a look at strategy in an appropriate way. For example, Eastman Kodak, and how do they respond from the transition of us taking pictures and then developing those pictures to digital cameras and how they're influencing what's going on. The same kind of issue can happen in sports in a heartbeat, and that's why we need to effectively look at strategies to see where we're going to go in the future. These strategies can include expansion strategies, how do we grow, and what is that process, or exiting strategies, how do we leave a market or sell ourselves off or go bankrupt if we don't have enough money. Whatever it might be, this module is going to be covering that in greater detail. So have fun with this, because this is the module where you really get to be creative. Once you know the tools, then we can start looking at strategies, and that's what we're going to be really focusing in on here, because I think that's the most exciting part of this, and the tool that if you can analyze the numbers effectively for a sport organization and then develop appropriate strategies that will help make the organization money, you're guaranteed significant amount of job and career growth, because people are going to want you because you understand the numbers and can process the numbers and not just tell us what happened, but can tell us why it happened and what that means for the future and how to look at that in terms of strategy for the future. I hope you've enjoyed the course. It's my pleasure teaching it. I look forward to having a lot of discussion board time with you guys, as well as reviewing your projects and everything else. Take care. Bye-bye.